of March, and what a week in review we have to look back on. We have obviously our usual two commentators for Sunday of the month, with Mike Muller, head Vitol Asia, Christoph Ruhl, senior research scholar and Center on Global Energy Policy at Columbia University. But I wanted to start off this morning on the politics of all of this situation in Ukraine. I thought, well, where can I find somebody who's a specialist in contemporary Russian politics, particularly in the Russian oil industry and its impact on countries' politics, economic development, and foreign policy? And lo and behold, that person happened to be right on my doorstep in Abu Dhabi, and not some other far-flung corner of the world. So I want to kick off this morning with Dr. Lee Chen Sim, the assistant professor at Khalifa University in the UAE, originally from Singapore, but an expert, geopolitical expert on Russia. I mean, where to start? I think the first question I would ask Lee Chen is the headline of the morning, really, that the US is looking at providing aircraft fighter jets to Poland so that Poland can lend its fighter jets to the Ukraine. Ultimately, my question to you is this veneer of war that is just between Ukraine and Russia, can that hold under these circumstances when indeed the West is doing everything but pulling the trigger? Your thoughts of the geopolitics perspective from a Russian side, that this is quickly moving into a multilateral front for them.
That's right. So, depending on, who's looking at it as it is in politics, whose perspective you take. So if you're looking at it from the Russian perspective, they'll definitely see this as a ratcheting up of US involvement. What with the sanctions and the arms transfers from Germany, and now it's not just arms transfers, but it's fighter jets. So you can see the progression from the Russian perspective of it being ratcheted up. So the Russians will obviously be less and less pleased. But from the US side, from their perspective, it's also a ratcheting up. But I think domestic politics comes into play a bit here. In the US, as you probably know, they're thinking of stopping the imports of Russian oil, even though that doesn't make really a difference. And so the fighter jets is again a ratcheting up of attempts to be seen, as you said, the veneer of supporting Ukraine. That's quite important to some sections of the American public, American Congress. Indeed, you've got elections coming up. So I think all these factors come into play, but yes, it is, it looks alarming both from the US and the Russian perspective in terms of a move towards bigger involvement.
Christoph Ruhl, the big story last week as well, I mean, these are all colliding stories, colliding narratives, is the inflation narrative and the tightening cycle that the Fed is moving into, and Jay Powell spoke last week. How do we see the collision of the tightening cycle, inflation now just in from Europe, beyond higher than even forecast at 5.8% in February? We've got most people screaming stagflation now with the collision with the Ukraine story. How do you see these two colliding stories and how that will play out?
That's a very good morning. That's a very complicated mosaic. But let's remember the basics. One of the basics is that when you have just an increase in energy prices, it's usually considered a shift in relative prices and transitory, because for inflation, it matters only as long as it rises. And almost by definition, it will not rise forever. That's why the Fed makes this distinction most normal people wouldn't make between core inflation and other inflation. If it's bottlenecks and things like that, which emerge now in the course of the war, it's a different story. And it looks as if the inflation imprint in Europe comes in higher than expected, above 6%. That would force the ECB into action earlier than it would have otherwise. But it also looks, and that's the big counterpoint to higher price increases, as if the market gets seriously sort of non-thrilled, non-pleased, nonplussed about this whole exercise, and continues to go down with people taking money off the table, which has been sitting there for 10 years. And there's a lot which could be taken off still, when people don't want to risk their profits. That's the classical scenario in which the Fed would sort of step down a little bit off the brakes and say, okay, let's take it easy. And so on balance, I think the current situation has moved more towards a 0.25% rate rise and away from an 0.5% rate rise, because the Fed has this inherent bias. And let me say something also relevant for this argument, which in connection to Li Xin, it's I'm starting to wonder, right? The US knew perfectly well what would happen. They were warning the world all along about this invasion coming as a full-scale invasion. But they didn't do what would be the natural thing, is send the 41st Airborne there, send a division into the Ukraine before trouble starts and tell the Russians, okay, that would have probably avoided the whole thing. And Biden, as she says, is in such a weak position. So it was before the midterm election. He really needs to stoke up a little bit of trouble for the midterm elections. And I wonder if that's the direction we are going. And coming back to your question, that would make markets even more put them really more on edge. And that would also make the Fed, sort of give them all the excuses they need to slow down. And the effect would be higher than anticipated inflation, but not the avoidance of the economic impact of the war, which is not positive so far, in particular on the poor countries with all the missing commodities and grain exports.
Mike Muller, the other big story, obviously, again, part of these multiple narratives last week was the idea that the US and others, whether they should sanction Russian oil, and that Russian oil and gas were still not part of the sanctions, and yet were being substantially disrupted because of the mechanics of the sanctions and people's uncertainty about the legality of things. But yet, with oil trading, Brent closed at 118, but yet the discount to Urals was so massive that Shell couldn't help itself. Business is business, and if it's legal, I'm buying. Your thoughts of where the market dynamics go as long as Russian oil and gas lifting it is legal?
Yes, I wouldn't quite put it that way, saying it was irresistible opportunity or anything like that. It is not illegal to purchase Russian oil yet. However, the means to do so are being tightened, where not by government imposition, then certainly by voluntary moral imposition of restraint, be that ship owners, be that insurance companies, be that the people that help maritime things move. And in this case, of course, the economic incentive compared to historical norms for Urals, which would have traded for the last 8 or 10 years at between -10 and +$1 per barrel versus dated Brent, is indeed phenomenally large. On a standard-sized cargo from the Baltic to Rotterdam, where this cargo is probably going, you're talking about an incentive of $15 to $20 million, just to be conservative. However, I'm pretty much convinced that that's not what Shell's after. And Shell actually came in afterwards saying that the proceeds from this uplift in revenue would go to humanitarian aid, which I think is a smart way of putting a postscript to it. But yes, their line was very simply, we had to consult with politicians, presumably in Germany or Netherlands, where Urals is such a large part of the supply chain that stockouts will be a consequence. And therefore, I imagine that Shell would have put a question to government: do you prefer that we run out of oil in a part of the Rhineland, or are you okay with us making this purchase? I'd be very surprised.
Are we in that? Yeah. Is that a credible argument? Is that a credible? In terms of, is the market that tight that if you don't lift this Russian Urals, some reporting is saying it's already disrupted by about 4 million barrels a day. If you don't lift it, as your example in the Rhineland could be, or whatever geography, could actually be without oil or without that requisite energy.
Absolutely. And I don't need to be accused of sticking up for my former company here, but the market was already extremely tight on oil. Last time you had me on this panel was early February, and we had no idea nothing was going to go on in Ukraine. Yes. And I was telling people, watch out, we're just one headline away from this market spiking because of low inventories. And we had backwardation back then, which was disincentivizing storage, and we had already had SPR releases. So what a headline, I guess. It is without a doubt a fact that in places like Germany, where some refineries run 100% Urals and others have it as the largest grade in their diet, it is awfully hard to come by other crude when you have a delay or a disruption in the supply of any other crude stream. And just look at what's happening in Libya, just as one of many examples of disruptions. So, I mean, a lot of headlines that would normally be front page have been drowned in the back pages as we are all consumed by this Ukraine tragedy. But yes, I do believe that it would have resulted in stock outs. And there are some headlines out there saying it would probably have been a stock out. I'm convinced that it would have definitely been a stock out. And then it's a question of, do you want to start inconveniencing Western consumers? And of course, this is the point, inconveniencing in the light of the tragedy we're seeing on television in the Ukraine. You are beginning to see headlines about the fact that, yes, maybe we should start inconveniencing ourselves. But a couple of observations, because in the global picture, you still have some places that are buying Russian oil. And you asked about the bigger picture. China came out with a statement last week saying it's business as usual. They will continue to not sanction and therefore continue to import Russian oil. And of course, China consumes most of the ESPO, the Pacific Russian crude that comes out just on their doorstep. The consensus view now is that they might have to be the backstop home for a lot of the Baltic Urals and even Black Sea Urals, to the extent that it's loading. That will have to find its way east if the West rejects its wholesale. And in that scheme of things, yes, you just at $118 Brent price, is 28 the right number? I think you will probably find that other companies engage with governments and get the okay to buy as well. But that's just oil. Let's look at other commodities. Oil has actually not yet made its all-time highs, unless you express oil in euro terms, in which case it has. But remind ourselves, the high in 2008 was 147, so another $20 to go. But if you look at other energy markets that are of more importance to Europe, especially as it's still, the end of winter, coal, natural gas, these are all-time high prices. Natural gas went and triple peaked at a price in excess of 200 euros per megawatt hour. And API2 coal is trading at $430, $440 last time I looked. So you could again say that the oil supply chain is a little bit more resilient, has more depth to it, and hasn't yet panicked in the way that those utility markets already have.
Yeah. Dr. Lee Chen, I wanted to ask you your thoughts vis-a-vis, obviously, the politics of this. Where is there the possibility of some give or something changing? And I wanted to get your views on Putin himself and his grip on Russian politics and Russian power. Does he have any vulnerabilities? I mean, if he has an oil industry that is essentially, collapsing, castrated, whatever the right phrase is, ultimately seriously constricted, does he have vulnerabilities internally with economic outlook and so forth? How locked solid is he in this moment?
Oh, good question. I believe that you've spoken about it, and so have other people, about the concept of a fortress Russia. And so this is the idea that Russia has basically built up its, pre-planned or pre-strengthened its economies ever since 2014. Because don't forget, the war in Ukraine did not just start in 2022. It was already there in 2014 with Crimea and with the two other republics, claiming independence. So we have to see that Russia actually, has strengthened its economy, various capital controls, etc. And it looked like it was in pretty good shape. But obviously it's tanked, the ruble has tanked, the stock markets has tanked. So other vulnerabilities in Russia, definitely with central bank sanctions, it's a whole new ballgame from 2014, not just with central bank sanctions, but also with the participation of the West and the US, as we talked about earlier. They're very much more into the sanctions game. So there are vulnerabilities on the economic front, but not great yet, because Sibir Bank is not yet sanctioned. And as we've all mentioned, energy sanctions, oil sanctions, energy sanctions are still not being imposed. There's a lot of self-sanctioning, but not actually real sanctioning. So in that sense, economically is still rather, there are vulnerabilities. But on the political front, on the political and social front, yes, we've seen demonstrations in Russia, in Moscow, but these have not been the huge kinds of demonstrations as we've seen in the past, demonstrations in Russia. Lots of people are scared, obviously for very good reasons. Oligarchs are, annoyed, but again, there's not a big source of resistance because they are oligarchs, and obviously they can hide and transfer and move money and assets, as we've seen in the press recently. So that's not going to be a huge source of discontent. Although I will say that I've got friends in Russia who are saying that there are some people who see Putin as increasingly isolated, and they've been flagging the possibility not of a coup, but of one of his inner circle, trying to stem the problems by some kind of political change. But
I suppose overall, it's clearly at least, I mean, of all of the things Fortress Russia might be vulnerable for, it looks like Putin is the most solid in his fortress at the moment. Christoph, just picking up on the points Mike made in the end of his commentary there about the fact that all commodities are rising and there's been massive leaps and the consequential impact on inflation, which was already at these multi-decade highs. The point there on the collision, you mentioned that the Fed, the central banks, will step back. Does that mean we have to accept that inflation is going to be very significant? There's no way to avoid stagflation. Your thoughts on that stagflation outcome, which is now increasingly looking very much more likely?
Just like a little bit like what Mike said about energy prices in February. He said it would go up, and they did go up, and they would have gone up without Ukraine. And so inflation, for months we have been saying it will go up, and it would have gone up without Ukraine, and Ukraine is not going to make it better. So we have to put these things around the sanctions mechanism and the energy price increase in the order in which they occur to understand them. Initially, everybody understood this before the invasion. The worst case sanctions to be like a pincer movement. Financial sector sanctions on the one side, curtailments on the Russian exports of commodities, including energy on the other side, both aimed at targeting and probably eliminating the balance of payments surplus, which feeds the Fortress Russia. What has happened after the invasion was a movement only on the financial sector, but much stronger than anticipated, including the freezing of central bank assets, and nothing at all in the commodity and energy sector, no sanctions there, as Mike has said. Now, but the movement on the financial sector was so strong that it effectively did away with Fortress Russia, because the central bank, which lost its reserves, cannot stabilize the currency, cannot act on anything. And so the fortress is more or less gone. What the implications are for Putin and how long he will stay in power, I lived in Russia for years. The only thing I can tell you with certainty is that we will learn about it only after it has happened. But there may be something happening. But what it means for the economy is that these sanctions on the financial sector, the disruption are so massive that we have the short-term disruptions, which Mike was describing, everything going up because traders don't want to touch it, and there's no insurances for the cargoes, and it requires a very, very steep euros discount for anyone to buy Russian crude at the moment. And I'm guessing that this is similar in other commodities. So a spike in the short term, but in the long term, very importantly, what this means is that Russia will have to export in order to get some cash. They have lost their reserves more or less, most of them. They rely on China for swaps. And guess what the Chinese want in exchange to give them hard currency swaps? They want more commodities, more energy, more oil, more gas, more coal, more everything, to the extent the infrastructure allows. So in the long term, this will have a rather depressing effect on oil prices in a world in which there's enough oil. Now, the problem, of course, which we've been debating for the last 2 years, there is enough oil, but it's highly, highly concentrated. And so it will depend on how OPEC Plus reacts to that. But I think one last point is also important to recognize. We always say $100 oil, terrible. What we really need to do to compare and the high oil prices have these two effects on inflation and on real economic activity. What we really need to do to make a judgment is to adjust the current nominal oil price for inflation and for the efficiency improvements in using oil, just to make it comparable. And then, the oil price increases in the 70s, which really did cause a recession, they were, by today's prices, close to 200. The high price period, 2011 to 2014, compares to about 140, if you factor in inflation since then and efficiency improvements. So we should be a bit more moderate. If we want to suffer a little bit for the poor Ukrainians, the oil price is not the worst place to start, and it has some headroom to go before it brings down the economy. Some of the commodities, and in particular the grain exports for poor countries, is a more pressing problem.
Yeah, that sure is for Egypt in our neighborhood. Mike, my question just following up on that is, does it matter now if indeed, or will it make a difference if the US and other allies do sanction Russian oil and gas best so, but let's just talk about oil, given that it's already disrupting itself, it's already self-censoring itself, and hence already built into the oil price?
It will. And yes, you're right to say that it looks like much of the Western Hemisphere Russian export program, other than that down the pipelines, is still up in the air, and as is the case with the normal spot market cycle, not yet placed from April onwards. But there's a huge question mark over it, because you're talking about close to 3 million barrels a day, I think, that flow into both the Druzhba pipeline into Europe, 700, 800 something thousand barrels per day. And then, of course, very large flows out of the Baltic and to a less extent out of the Black Sea. The world does not have enough spare capacity. And I don't know if I misheard Christoph there, but the world doesn't have enough crude either. Never mind the little wobble in Libya recently, but unless we get Iranian oil back, the supply-demand balances with full Russian production in the picture were not enough. And we were concerned about where the oil was going to come from to go around, and whether the Permian Basin could catch up quickly enough. And we were talking about the possible need for SPR releases just to address high oil price, with nonsense like the midterm elections in mind, to appease the electorate in North America. Now, with millions of barrels a day of Russian oil probably likely to be packed in, some of them perhaps making the long way around through Suez or even around the bottom of Africa to Eastern Asian markets, the impact is going to be very profound. If you have to build a artificially long maritime pipeline to transport the oil to another hemisphere, that does away with a month's worth of demand as that oil's in transit. It's like a line fill on a pipeline. And even if all of it goes there, there's still going to be a shortage of sweet barrels for the Western Hemisphere refining system. So the market is telling you that because it's showing you a $5-6 per barrel backwardation, which we've not seen since the very first Gulf War in 1991, just before Desert Storm. I mean, this is unprecedented stuff, and the market's just telling you there's not enough oil at the prompt, and the law of high price is going to have to weed out the weaker demand and destroy it.
Given that, Mike, there was a lot of commentary after OPEC's meeting last week, kind of the sort of metaphor head in the sand, disappointing was what Fatih Birol said. The OPEC decision to essentially ignore the Ukraine crisis was that, I mean, put the politics aside of that, but from an oil supply point of view, you know, stability of the market and all the things that they advocate, was that in essence, will that decision deliver their stated outcome, which is stable markets?
Okay. Christoph wants to butt in, did you, Christoph, before I answer that?
No. Just, I was just occurs to me, it's just like the Fed, you know, has a bias and they don't like to increase interest rates. So OPEC stability has a distinct bias and they don't like to lower it. But I wanted to say, Mike, you can take it up in a second. But the point I was trying to make is that these are adjustment processes. Prices will spike, you know, the discount will go to whatever height it takes. And then at the end of the day, you know, that will be a carrot big enough for people to buy it. And so we will see at the end of the day, and this is probably what worries OPEC too, an effect on Russian exports, which forces them to export more. They really become sort of a pariah dependent on natural resources and nothing else they can sell. And that will be the day when, which probably OPEC tries to find a bridge until then, OPEC plus.
I mean, it strikes me that the discount won't last, the scale of discount won't last that long, because it's only the window now of uncertainty. Either the West will sanction or they won't sanction, and that will become clearer. But Mike, your thoughts, again, just to pick up on the OPEC point, we had the OSPs over the weekend, Saudi raising prices again. OPEC didn't act last week. The IEA called it disappointing. Others called it head in the sand. How would you analyze it?
Well, because the Saudi OSPs take into account things like the structure in the Dubai market for Asia and the Urals differential in Europe, in very large terms, the Saudis would have had to follow the Urals market, which is at the point they issued their OSPs was a notional price. And of course they didn't, because there's already, certainly from talk in the market, there is a stronger uptake and a stronger nomination for more oil from Saudi Arabia and from OPEC as a whole than they have in mind to put on market as per their last meeting. So they're going to have this challenge every month now. The market's going to be asking them for more than they give, or than they're prepared to give. And at some point, surely the temptation is there at 120, 130. At what price will they say, okay, I think our COVID response that we agreed in early April 2020 is history now, and let's get back to focusing on the fundamentals of today's market, rather than somehow managing inventories from COVID, which is very much no longer the theme of the day. And I mean, yes, the OSPs in Asia, they could have been, I mean, in the current market, they could have been higher. Yes, I mean, they're pricing the oil to move. The model suggested that they come in roughly with the $2.50 on average premium increase in Asia. And in Europe, they of course didn't follow Urals because they don't have to, because there were call-ups from refineries in Europe to buy a lot more Saudi than they have in the past in order to move away from Urals crude. But the disruption is across the board. I mean, ship owners now have the opportunity to put money in their pockets, yes, because in the Black Sea they're going into a war zone, and in the Baltic they're dealing with the challenges of not being able to transship in the Danish Straits, and they're dealing with British port workers being instructed not to receive ships that have any Russian nexus, not just Russian flag tankers. And we have some similar headlines coming out of the US just recently. So I'm not sure whether this minus $28.50 price for Urals is going to be the low and it's going to bounce from here, as you suggest, Sean, in case that's what you were saying. I mean, at $120 oil, some people have commented that the market may yet equilibrate at a different level, but it creates a market that is disjointed. And how on earth do price reporting agencies start assessing not just Urals crude, because that's an easy one because it is what it is, but how do they start assessing products that include streams that come out of Russia, or that might be blended with material that comes out of Russia? It makes the messy assessments in Asia, where let's say sanctioned Iranian barrels make their way into the blend, makes it look a small problem. So I don't envy them. It's going to be quite a challenge.
Well, I know we're only 10 days into this. Let's get the survey question, which is addressing this point. Has the oil market already priced in the disruption of Russian oil, i.e. the sanctioning of that disruption is already there? So whether it's actually a sanction or it's just self-censorship, the market has already priced it in, yes or no? Obviously, we're getting to the end of our half hour together with the outlook for the week ahead. Dr. Li Chen, I wanted to focus your thoughts on the week ahead about how solid the China-Russian relationship will remain. Is there a point in which even the Chinese are going to have to relent, like the rest of the world, on their partnership? It seems even India is reluctant to give up on Russia, given their reasons. But the China-Russian bond, how solid is that, do you think?
Well, supposedly it has no limits, but if you know the Chinese, business is business and politics is politics, they tend to separate it out. And so if they're going to have to charge a premium for, let's say, taking some of the yuan trade from Russia, that's what they'll do. So I don't think that there's such a thing as a free lunch. But yes, they will try to make Russia maybe a bit less vulnerable. But I think from my point of view, they will drive a very, very hard bargain for that. You know, I do see the relationship continuing. There really is not much of an option but much more for Russia than for China. China still relies on the US and on the West for much of its trade. Something like more than 25% of its trade is with the West, or with you know, Europe and US put together, whereas with Russia, it's just 2% of Chinese trade. So, I mean, you can see the writing there on the wall. So they will try to hedge, as the Chinese like to do, as best as they can. But certainly you will see that they're going to come under more and more pressure, with the Chinese banks not really wanting to give out letters of credit. So I think you'll see more of this happening.
Yeah, it does, Christoph, seem like we're the week ahead and the week behind, but it increasingly is a pronounced point is you have to choose a side here, Nerly, it seems. You're obviously on your way to CERA Week in Houston, obviously one of the world's biggest energy gatherings. How do you see the next week playing out vis-a-vis the last week? Obviously, the war looks like it's getting worse. I mean, this siege on Kiev looks like it's going to get, you know, the TV images. We haven't seen anything yet. Your thoughts on how this plays out week ahead?
You know, I was thinking about this. If you take Putin seriously, and I think we should, and this is an ethnically motivated war, and he thinks, you know, this is the home of all Russians, he needs to protect his people, He also doesn't want anyone in the post-Soviet space to see the light, you know, so they all need to see Russia as the best they can hope for, which is why he went to Belarus and Kazakhstan to suppress people. Under those circumstances, what we now call ethnic cleansing is usually a legitimate sort of idea, or semi-legitimate idea coming to these people. So what I'm trying to say is I would not be surprised if he's secretly likes the idea to create 3, 4, 5 million refugees. The Ukraine has 40 million people. He probably thinks half of them are traitors who need to be exterminated or chased away anyway. Everybody who leaves is by definition somebody who doesn't look forward to coming home back into the whatever the new country is. Everybody who stays is either a supporter or an ardent enemy. So why not clean out this and create a giant refugee problem for the West, get rid of some of these people, and then deal with the enemies, and you have the supporters in place. It's just one thing. But what I really look forward to next week is clues on the willingness of Russia to find a way out. So these humanitarian corridors might be an indication, if it's not evil, driven by evil, as I just suggested. Willingness also within Russia. You have to put your head off these people who go on the street, 8,000 arrests, and I want to be one of them. And willingness of the business cycles and of the government people to put an end to that. It has to come at the end, I think, from within Russia. I know I think many people, it's fair to say, in government who are now exposed to sanctions. These are exactly the kind of people who always argued we don't want Russia to be pushed in the same boat as China and Saudi Arabia. They always saw Russia as being sort of talking with people in Brussels, in London, and yes, in Washington as well. And they're all sort of pushed into this corner where they don't want to be. They're all afraid, of course. They're all now cut off from their refuge in the West too. At some point, when the pressure gets high enough, maybe things change internally, but this is impossible to predict from the outside.
It'll also be interesting in CERAWeek whether this narrative of US sanctioning oil imports becomes a part of the US energy sector lobby for that to happen. Mike, let's get the survey question result and give you the last word this morning. My question to you, Mike, is, has the oil price already been priced in? Disruption, yes, 2-1. My question to you, Mike, is that on the back of that has the kind of big disruption of the energy markets now is going to play out, and we'll get to some kind of new status quo where this becomes manageable? Or is this scale of volatility, do you think, going to remain in the oil markets going forward this coming week in particular?
I'm afraid we have plenty of twists and turns yet to come, and more headline-driven trading. And I'm not sure the fundamentals have borne out what I've been saying yet in terms of tightness and pockets of scarcity expressing themselves in yet steeper backwardation potentially. Indeed, we wait and see what actions of various protagonists will continue. Much centered around the withdrawal of the, well, I won't get into geopolitics here in the concluding statements, but I think the withdrawal of the Russians or the new terms that Foreign Minister Lavrov stipulated around the nuclear talks with Iran is another headline that's been drowned recently, but very profound, I think, because it did appear midweek as if they were very close to resolution, and both sides were promising on the Twitter sphere that there was an agreement about to happen, and the oil price reacted accordingly and dipped something like $5 per barrel. It doesn't look like that it's terminally off now, but it does seem like the Russians have demanded that if there is to be a deal, that trade ties between Russia and Iran will not be impeded by the international banking system, etc. So there are going to be many twists and turns, and I'm afraid that whilst I think the world is already pricing, in terms of the backwardation, the fact that there is going to be an inability to take a serious amount of Russian oil in the Western Hemisphere, I don't think we've priced in everything yet, and there are things that we probably have yet to have to absorb into our reckoning here. So I
wouldn't be right to let you go with our monthly visit together without some comment on China. You started out this morning, I think it might have maybe be even before we started, but that there was so many other things in the bucket besides Ukraine already tight. China has just announced its outlook for the year, forecast growth at under 6% for the first time, I think, in decades. Hong Kong is literally imploding under the weight of the COVID pandemic. ICU rooms all full. Looks like Italy 2 years ago. What's your sense of where China goes this year vis-a-vis economic performance and hence oil demand?
Well, I'll answer quickly first. China is clearly setting out to throw a lot at the infrastructure section of the economy. And when they say 5.5%, I think that number may have come as a relief to some rather than as a shock. Or certainly in line with expectation. So I do believe that they have in mind to stimulate the economy and to ensure that economic growth comes first. And they've made it very clear in the resources sector, where in that delicate balance between growth and productivity, and also in terms of emissions, they've made it pretty clear that productivity and underpinning the economy is the number one priority. And that therefore, whether it's instruction to the coal mining sector to mine more coal, whether it's instruction to a industrial facility to get the output back to normal after the emissions curves that were set in front of them for the Beijing Olympics, all that is back to normal. And I keep saying it every month here, Sean, I think China will deliver positive economic results.
Well, it does seem to me that it's going on, and again in the quiet on the side, that the cuckoo in the coal mine of the COVID challenge that China is going to face this year is significant, and Hong Kong cannot be ignored. And with it, perhaps even the end of Hong Kong as the global financial center, which may have happened anyway over time because of the political outcome, but certainly it looks in a fragile place. But the other thing about China, I think, which is worth noting, and is how do they replace the 30% of the economy that's built around construction? It's a bit like Dubai in a much smaller way. We can't keep building. You have to replace it with something more productive, and that is something that I think is struggling with China's transition at the moment. But that's a whole nother universe. We're well over our time, inevitably, given the week that's in it. It's worth an extra 5 minutes. Dr. Lee Chin, thank you so much for joining us today and disrupting the two boys from having a good old natter. Christoph and Mike, as always, thank you so much. Really look forward to hearing how Sira Week goes. I'm jealous that I'm not going to be there, but enjoy. And Mike, same safe travels to you, and we'll catch up again soon. All the best.
Thank you. Bye.